Today, I share a Tfsa dividend income for the month of July from 15 paychecks. Let's do this. For those that are new here, my wife and I do our finances together, so I'll share a combined Tfsa dividend income we receive through our 3 investment accounts with Scotia iTrade and Wealthsimple. Before I jump into who paid us and how much, let's take a brief look at our portfolio's dividend calendar. You probably noticed January, April, July, and October are the heavy months, and February, May, August, and November are the light months. March, June, September, and December land somewhere in the middle. Just so I'm 100% transparent with everyone, I'll be sharing my dividend income based on when it lands in my account, not based on a payout date. In July, we received dividends from the following companies. I'll go through each holding according to the dividend weight, not payout size in my portfolio, starting with the smallest. I'll be adding up my totals along the way and see where we land this month. Our smallest dividend received was $2.73 from Vanguard's S&P 500 Index ETF, VFV. It provides 0.1% of our total dividend income. Virtually nothing right now. This should be much larger, however, I haven't really purchased any shares during the market downturn. I was away for much of July and didn't gobble up more shares. It was very well valued just a few months back when the average PE went below historical averages for the S&P 500. This will never provide a huge portion of passive income for us, as it is the growth play in our Tfsa. Next, our newest financial stock, Goeasy Ltd, paid us $6.72 in July. This gives it a weighting of 0.3% of our dividend income. Goeasy has been in a position I've been wanting to build out for about a year. Just recently, there was a major pullback, bringing the share price well below $100 and giving it a yield of almost 3.8%, only to shoot right back up to what I consider fair value at around $140. That gives it a dividend yield of about 2.5% while preparing this update. This is well above its 5-year average yield of 1.7%. However, it has been growing dividends at an exceptional rate of 39.5% compounded annual growth rate over the past 5 years. The stock has also appreciated at 32% compounded annual growth rate, making for an exceptional return over 5 years. I'll be watching this closely, as I want this to turn into my replacement for Fiera Capital in my portfolio at some point. After our first 2 paychecks, we're at $9.45. Next, we were paid $19.92 in dividends from Canadian Imperial Bank of Commerce, ticker CM. They provide us with about 0.9% of our annual dividend income. This was a staple in our financial-heavy portfolio until I chopped it down well before the stock split. They continue to grow their dividends at a rate of 4.4% CAGR over the past 5 years, with a tiny 3.1% increase over their last payout in April. The share price has been stagnant, growing at 3.7% CAGR over 5 years. With a recent pullback, I'll be looking to build up my position again after taking a lot of gains. This is more of a value play than dividend growth play in reality, as I see CM underperforming the banking sector in Canada. I will look to continue to add more to this position as the PE is well below their historical average, as is their current dividend yield of 5.5%, well above their 5-year average yield of 4.7%. The market is moving so fast, so time will tell how much I'm able to add to my dividend income with this one, and if it will be the best value of the 3 banks I hold in my Tfsa. That brings us to $29.37 for the month. Next at $23 is our one closed-ended investment fund we have, Canoe EIT Income Fund. It provides us with 3% of our yearly dividend income. My yield on book value is so high at 11.15% that I can bite the high cost of owning this income fund. I'm not an income investor, nor do I plan on it, as I continue to mention over and over again. I'll keep this one on the back burner and use the monthly distributions to purchase other high conviction stocks I have in our portfolio. And if the time is right, I'll dump my shares. I know I sound on repeat, but nothing has really changed for me. This fund is heavy in value stocks in Canada and the US, so I have no worries about the fund continuing to pay that distribution indefinitely and holding long term as well. Now we broke the $50 mark at $52.37. Our next pay was $71.10 from Telus Corp. They provide us with 3.1% of our yearly dividend income. This is a staple in our turf portfolio and one of our 2 telecoms after completely getting out of Quebecer. Telus is currently trading just a bit above its 5-year average yield of 4.5%. There was a modest 3.4% dividend raise from last quarter. I wanted to accumulate more during the crash when it pulled back 20%, driving up its yield. A 3.4% raise is more bearable on a higher yielding stock. Telus has a 5-year CAGR on its dividend of 6.7% and a 5-year CAGR on its stock price of 5.5%, making for a pretty decent total return. Telus is more about total return than just the income compared to BCE. I still want to double my position in Telus as I see it having a better future dividend growth than BCE with its new revenue streams outside of just a pure telecom. This brings our total to $123.47. Our next dividend received was $38.22 from a monthly payer, Pembina Pipeline Corp. It pays us 4.9% of our yearly dividend income as one of our 3 in the energy sector. This stock is trading well below its 5-year average yield of 5.7%. PPL hasn't raised dividends for almost 3 years. And then, boom! The board approved a 0.75 cent dividend increase pending the closing of the joint venture with KKR. I was expecting it. That represents a 3.6% increase of its dividend. Despite that small increase, it still has a 5.8% 5-year CAGR on its dividend. The energy sector has pulled back up with the market in July, after reaching all-time highs at the start of June and then tanking. I think the oil cycle may be, just may be, coming to an end soon. A few things need to happen for that to happen, which I won't get into. If it does happen, everything in the sector should continue a downward trajectory for the next while. I'll continue to take these dividends and reinvest them in other better value dividend growth stocks until I see PPL at the right price again to turn on the drip. So after 6 paychecks, we're at $161.69. The next paycheck was $124.81 from Algonquin Power and Utilities, enough to drip 3 shares in our iTrade account alone. AQN provides us with 5.3% of our forward yearly dividend income. It is trading around their 5-year average yield of 5%, which could indicate it is fairly valued right now. With the recent recovery of the stock price, dropping the yield to 5.2%, and earnings coming out next week, I'm on the fence whether to grab more shares or not outside of the ones I drip. I really like the discount on drip shares though. The last dividend raise was 6% the other month, and it has a 10% 5-year CAGR on its dividend. I still think there is much room for this renewable play to grow its dividend in the near future. So at the halfway point, we are at $286.50. Before we continue, let's quickly hear from our sponsor, me. So please hit that like and subscribe button. In exchange, you can see what a summer in Vancouver looks like for us. And now back to what you came here for, dividends. $44.45 in distributions from Smart Centers Real Estate Investment Trust. They provide us with 5.8% of our forward annual dividend income as one of 2 companies in the real estate industry. This is a staple in our turf portfolio with its monthly distributions. I gladly hold this in our Tfsa since we don't have to worry about the tax headaches of holding REITs in our taxable account. They are trading slightly above their 5-year average yield of 6.1% with a yield of 6.3% in early August. This could mean it is fairly valued right now. It is below my yield on cost. They haven't raised dividends for almost 3 years, and I don't expect them to anytime soon. They own many properties that will be densifying in the future, so there is much potential to bring back the 3% raises they used to do in the past. I'll continue using their monthly distributions to reinvest in Smart Centers when or if it pulls back again like it did in June and early July. After 8 paychecks, we are at $330.95. Last month, we were paid by Fortis, my OGO utility stock. This month, it's my fave's turn, Capital Power Corp. They provided us with $143.45 in dividends and represents 6.5% of our annual dividend income. With the market getting pummeled since February, CPX is now trading at around its all-time high, giving it a yield of 4.4%, which is really low compared to its 5-year average yield of 5.8%. This could indicate it is overvalued. They also had a dividend raise of 6% on August 2nd. That increase was a little lower than their 7% CAGR over the past 5 years. They have increased annual dividend growth guidance to 6% through 2025 from the previous 5%. With the current yield, this comes under my rule of 12 that I like to follow. The stock price has also grown at 14.9% CAGR over the past 5 years, allowing for a really good total return. I hope to load up much more in the event of another pullback despite its large weight in my portfolio. In the event it doesn't, I'll be using their dividends to add to other better valued positions. This brings our total to $474.40. Next, we were paid $149.40 by Tfsa Energy Corp, another pipeline that will report earnings in August. This represents 6.5% of our annual dividend income. I love that they have grown their dividends for 21 years at a rate of 7% over the past 20 years. Just recently, they lowered their expected future dividend growth to 3 to 5%. Its most recent dividend increase was just 3.4%. I wanted to turn DRIP off for this, but I forgot. I wanted to because it breaks my rule of 12 I go by, especially with the recent run-up in price, which has dropped its yield to 5.3%. This is in line with its 5-year average yield of 5.4%. It is trading at around its fair value. I have a similar outlook for TRP as I do for PPL. If the energy cycle comes to an end, I'll start accumulating more shares when its yield gets back up to fit my rule of 12. After this big dividend payment, we hit $623.80. Our next paycheck was from our second telecom, BCE Inc. at $154.56. This represents 6.7% of forward annual dividend income. This is a core holding of our turf model. They raised their dividend 5.1% and have been growing them for 13 straight years at a 5-year CAGR of 5.1%. BCE has underperformed compared to Telus. Its current yield of 5.7% is above its average yield of 5.3%, which may indicate it is slightly undervalued right now. Its PE is above its 5-year average, which is a mixed signal, showing it may be overvalued. With my yield on cost over 6.5%, I'll continue to drip it, as it just makes my rule of 12 as of right now. The market may pull back up again, as it has overall, making BCE not worth the drip. With our 11th dividend, we arrive at $778.36. Our next dividend received was $158.28 by Bank of Nova Scotia. This represents 6.8% of our forward annual dividend income. BNS has been paying consistent dividends for over 100 years and growing for 11 years until the Canadian regulators put a moratorium on dividend increases and buybacks in 2020. The other month, their distribution increased by another 3% after an 11.1% increase at the end of 2021. It is currently yielding 5.3%. It has a 5-year CAGR of 4.6% for its dividend and has a 5-year average yield of 4.7%, showing it may be a little undervalued. Its PE is also under its 5-year average of 11.1 at 9.33. The banking sector tanked when the market did in mid-July. BNS traded below $72, which we hadn't seen since February 2021. The only difference is BNS pays out a much higher dividend now, with the yield hitting 5.8% in July at one point. It was oversold and pulled right back up pretty quickly. They have earnings to report in August. Let's see if there's another good dip to pick up more. Now we total $936.64. My second largest holding is Power Corporation of Canada, and it paid us $191.57 this quarter. This represents 8.3% of our annual dividend income. This allowed us to drip a number of shares in our iTrade account at a good price. It has plummeted 25% since January and provided a good yield. At one point in July, it was yielding 6%. It is currently yielding 5.7% with a 5-year average yield of 5%, which may indicate it is undervalued right now. It is also trading well below its 5-year average PE of 10.9, another indication it may be undervalued. It will be reporting earnings in early August. We can expect a little bit of pain because of the current economic conditions. The most recent dividend increase was 10.6%, and it has a 5-year CAGR on its dividend of 6.9%, which is healthy. I'll continue to drip as long as they keep growing those dividends as they have for the past 7 straight years, and the PE stays in the 9 range. With our third biggest payer, we broke the $1,000 mark at $1,128.21. And now for our largest holding, RioCan Real Estate Investment Trust. They paid us a distribution of $64.50 across 3 accounts. This company provides us with 8.4% of our forward yearly dividend income, which is a little rich, but I like it. It has a 5-year average dividend yield of 6.16%, which is drastically higher than the current yield of 5%. This is mainly due to RioCan slashing the dividend by 33% back in 2021, as many of us felt. When the dividend is back to 2020 levels, hopefully within, let's say, the next 3 years, This will provide a yield of 7% at current prices. While I record this could indicate it is undervalued right now. They already increased dividends 6.3% this year, or a half cent. With the uncertainty of interest rates, the global supply chain issues, and the possible pending recession, REITs have pulled back with the overall market. And then, just at the start of August, they ripped ahead again. I'll keep dripping this all I can at this great valuation, 20% below NAV of $25. I see this as a core holding for stability and incremental income growth as RioCan adds density to their properties. Let's see how they do on their next earnings report on August 8th. I can't wait. This brings us to a total of $1,192.71. Lastly, we have our monthly financial payer, First National Financial. We receive $66.58. They provide us with 8.4% of our annual dividend income, without their special dividend. This stock has tanked since mid-2021 and continued to drop with the overall market. It bottomed out under $33 a share with a yield of 7.2% at the end of June, only to rocket back to $38 by the end of July. FN currently provides a 6.2% yield. With a 5-year average yield of 5.6%, this is technically undervalued still, despite the 16% run-up. I am comfortable adding to this position again despite the general sentiment about the real estate market in Canada after their earnings report. I like to accumulate fundamentally strong companies when they're out of favor or their industry or sector is as a whole. It also has paid out 5 consecutive special dividends in December. By the looks of it after their earnings, I see a 50-cent at most special dividend. Who says no to any extra payout? After 15 paychecks, our grand total is $1,259.29. Our top 3 dividend payers accounted for $504.41, or 40% of the $1,259.29 of dividend income for the month of July. As we grow the portfolio, this should moderate down to about 35%. I never want to be too dependent on any one company to help my portfolio grow in the event of a dividend cut. As you can see from the breakdown, no one industry or company dominates our dividend income. Now, a huge part of our dividend income growth are the dividend raises we receive. This month, not one company raised their dividends. Without any raises, we added $0 to our forward annual dividend income. Boo! This is the second consecutive month without a raise. I hope to have some in the August earnings season. So far this year, we have received $5,574.36 in dividends with a yield on cost of 6.6%. Our forward annual dividend income is $9,300 and growing fast. We expect our dividend income to continue to snowball as we drip and stay completely invested, putting those dividends to work for us. I think of my dividends as my little minions that work hard for me when I can't. With our minions working hard for us, we can forecast where we will be in about 10 years. I hope to outpace this forecast as the Tfsa contribution room grows in the future, especially with the high inflation we're fighting. Next month, we should be seeing some major price action with all the earnings releases. So hit that notification bell so you don't miss out on future updates. And please help my personal YouTube inflation by smashing that like and subscribe button. Thank you so much for watching. Until next time, I'm Mr. Financial.